Welcome back to Selling Your Business with David King. I'm David King, the author of Selling Your Business Begin with the End in Mind, which is available on Amazon. Today, I am joined by Ryan Smith, the founder of ThinkSBA. Welcome, Ryan.
Thank you so much, David. I appreciate you having me.
Ryan has got a background like 15 years as a banker and commercial loan officer. And that before he founded ThinkSBA, which is a loan brokerage to help business owners acquire financing that they need to grow or to acquire a business. Why don't you tell us a little bit about yourself, your background?
Yeah, thanks again, David. I was born in Wisconsin, grew up in La Mesa, went to San Diego State on a baseball scholarship, played a few years in the minor leagues. Shortly after moving away from California, I joined a bank in the Midwest, and we ended up moving back to San Diego approximately 5 years after. And that's when I really started to cut my teeth in commercial lending. And that's what I've been doing for, like I said, the past 10, 15 years. And recently what I did is I left the corporate banking world to start what I saw was a gap in the industry, to start an SBA specific or focused loan advisory and brokerage for small business owners and entrepreneurs.
So the focus of this podcast is selling your business, but there's no sale without a buyer. There's no sale without gas in the tank. You can't drive away on a car that's empty. So this is an essential ingredient to most sales. Most of them, the deals that we work on, are SBA financed transactions. So my focus is SBA 7A loans, and I'm assuming that we'll focus on that. Tell me though, when you're working with someone who's going to acquire a business and you get a little bit of background information about them and a little information about the business they're acquiring, do you sometimes have a gut reaction that's usually correct, and what's going to work for them, where to steer them, whether or not they're going to qualify for an SBA loan? Tell me kind of the first reaction you have sometimes.
So typically the way it goes, David, is I'll receive a phone call. Sometimes it's a referral. Sometimes it's just a call from my website. And what I'm doing in that first call is identifying what I call the fundamentals. And everything I do is based on the fundamentals. I have the borrower, I have the seller, I have the business. All of these components need to have the fundamentals. So when I'm speaking with a borrower, or in this case, the buyer, I want to know a few things about them. So for instance, I want to know, do they have direct industry experience in the business they're buying? A lot of times they do. Sometimes they don't. Sometimes they have what they'll call management experience. Another thing I'm looking for is strong personal credit history. There are banks out there that put a lot of worth in strong personal credit history. Now, the minimum credit score for the SBA is 640. But more than that, banks look at credit history. How have you paid your bills in the past? And so what I do is I ask a few questions. Have you ever had a foreclosure, bankruptcy, short sale, or the one that most people have had, that's a credit card charge off? If they're in the distance, they're in past history, we can have a good explanation. That's typically not going to kill a deal. So just to look at what I've already said. So I want to make sure they have direct, or what I call commensurate experience, at least management experience. I want to make sure they have good credit. Then I want to make sure that they have the liquidity to inject into the business itself. And the reason is, a lot of people call me and say, hey, Ryan, I can get an SBA loan and it's 100%, right? And I said, no, it's not 100% financing. Nothing is really. So you do have to inject a minimum of 10% into the deal. So I also look at personal liquidity. Do they have that? And then above the personal liquidity, there's something called post-close liquidity, which is also very important to lenders. Post-close liquidity is obviously cash in the bank or working capital accessible after the loan closes. So after they take that money that they have in their bank account, put it into the loan, how much do they have left over? So those are really the fundamentals that I look at. And if they have the strong management experience or commensurate management experience, if they have good credit, and if they have the liquidity, then that's typically a sign that we're going to have a successful transaction from the buyer's side.
It's funny. I've had people, when I'm representing buyers, ask me, does this look like a good price for this business? And I'm certainly like, well, that's not my job to tell you that, but someone who can is the lender, because if you're paying too much, they're going to tell you that this is a business where these cash flows generated by this business just aren't going to support that sort of a loan. How often do you look at the business and just say, this isn't going to support the financing?
So when I'm in an M&A transaction, business acquisition as we call it, I always look at the sale price. And here's some factors that we have to understand. Not only is there the buyer of the business, the seller of the business, but a lot of times there's a broker. And what the broker does is they put together this really nice package, and there's typically a page in that package that has what's called seller discretionary earnings. And seller discretionary earnings is typically inflated by the broker. And the reason is because if they can inflate the seller discretionary earnings, they can inflate the sales price, and then obviously they make a bigger commission. The challenge is when we get into underwriting, get an approval, and then we have to order a business valuation. And that's where the rubber will meet the road. So in my first conversations with buyers, when I have the broker's selling package, is let's look at the seller discretionary earnings and let's see what the broker is adding back will actually be added back by the bank. And I can tell you this, 100% of the time, what the broker is adding back as discretionary, the bank will not. Typically, this is what the bank will add back. They'll add back 100% the seller's compensation. So that's salary, maybe it's retirement, maybe it's taxes. So they'll add back all of that. They'll add back depreciation, and then they'll also add back interest and amortization if that's on the balance sheet. All of these other things like car payments, cell phone bills, trips to the Bahamas, inflated meal, right? Inflated cost of food and beverage and dining. Those things are not added back by banks. And here's why. The bank's going to say, look, the buyer is going to do exactly what the seller did. So we're only going to add back truly what will not be there when the seller exits.
Okay. That's excellent for people to be prepared early for the dose of reality that's going to come when a loan goes to underwriting. Now that you're out, that you're independent as a loan broker, are you able to work with people in helping them do what they need to do to get a loan that's going to get approved? Are you able to kind of counsel them on the way they need to package their loans and help them?
Totally. So what I learned about myself and why I actually exited corporate banking is because I realized about myself that I'm customer service driven, which means that I want to work with people that I can have success with. When I was in banking, I was an order taker. And what I mean by that is my chief credit officer, the president of the bank, they're the ones who said, Ryan, go do this. And these are the tools you have. And so, for instance, the last bank, the tools that I had I was the highest rate, the most expensive in fees, but I did have flexibility. So those were the orders that I took. But now as a broker, I'm not beholden to anyone's orders. What that means is I can bank my clients with any bank in the country. So I just booked a deal that was a real estate deal, but I booked that deal with one of the best and cheapest and most efficient banks in the country for owner-occupied real estate. That was an SBA 7A loan. Sometimes, though, I can't go to that bank because of qualification reasons, meaning that the business owner or the buyer will not qualify for that particular loan at that particular bank. So instead, I take them to a bank that does have more flexibility, their rate is a little bit higher, but they're able to get the deal done. And right now I can tell you I'm working on several business acquisitions. I'm working on acquisitions, if you can believe it, of restaurants. I'm working on a landscape company in Encinitas. And what I've done is in COVID, I've taken these opportunities and sent them to banks that are more flexible. And so what that allows me to do for my customer is actually serve them, advise them. I tell them and advise them how to structure the deal so that it's financeable and everyone can get to the finish line. What I tell people when I speak with them, especially the first time, is, look, I know what the landmines are ahead of us. And so it's my job to detonate them in the very beginning, because if we do that, we expose the things that are going to kill the deal at the 11th hour. And by doing that, now, once we've addressed those issues, we've mitigated those issues, as long as all parties agree to move forward in that direction. Now, once we get approval, we get business valuation, we finish up the documentation, and we go to loan docs.
Let me throw out two questions. Your contacts with banks, is that with loan officers at banks, or you don't bypass them and go directly to underwriting? You work with loan officers, or who's your contact? And the second question, right now, are you seeing things a little bit slower with still kind of getting out of this COVID situation?
That's a great question.
Yeah.
Slower indeed, my friend. I mean, I'm telling you, that is an understatement. So there's some things going on here. To answer your first question, I work with the business development officers. So in the SBA world, they're called BDOs, affectionately BDOs, but stands for business development officer. I work with business development officers, but here's what I've done in my practice. I've worked with and put together a portfolio of the best, most experienced business development officers. So what that means is I structure a deal as a broker, having been inside of a bank. But what I don't know is I don't know how that particular bank at any given time is underwriting their deals, but the business development officer does. And so that's where I structure the deal, and then I rely on the business development officer inside of the bank to structure it again specifically for that bank. And what I'm talking about structuring, I mean, so cash injection. I work with a lender. They like 15% most of the time. So not 10%, they like 15%. They like 5% post-close liquidity. So I work with the business development officers, and they're typically 20, 30 years in the business. And then what they do for me is, because I want certainty with my loans, they go to their management, and they can't come back to me and say, hey, Ryan, we're ready to do this loan, until they go to management and they get management buy-in. And so that's where, when you work with me, I don't throw anything up against the wall and hope it sticks. That does not happen. Everything we do, again, is based on the fundamentals. It's structured properly, and we go step by step. Now, let me address your second question, timing. I can tell you that daily, I am having conversations with multiple borrowers who are acquiring businesses on timing right now in the world of SBA. And here are the factors. It's really the perfect storm to slow everything up by up to 4 to 5 weeks, and sometimes longer. So the first thing we have is COVID, right? Unprecedented. That's turned the world upside down. That's affected hospitality, food and beverage. It's affecting retail. It's affecting almost every single business, positively or negatively. So that's the first thing. The second thing is that the SBA, as many people know, they will provide business buyers of businesses 6 months no payments. If they fund their loan, they have to fully fund it, fully fund the loan by really September 25th, because the 27th, which is the real deadline, that's obviously a Sunday. So the Friday before, which is the 25th, that's really the deadline. And then some banks, they've actually pushed it up a little bit to make sure that they don't have any last minute errors and hurt somebody and miss something. So most lenders, it's really about September 23rd that they'll say, hey, if we fund by this date, then we can guarantee. So,
and I'm sorry to jump. Now, this is a special benefit under the CARES Act right now, that the delayed payments, the deferred payments. Okay, so right. The loans are better get in the gates now.
And it is forgiveness. So just so you know,
Okay.
it is 6 months, no payments. It's not added back onto the back of the loan or anything. It is literally 6 months, no payments if they fund. So the loan fully funds by September 27th. But like I said, in this case, it's September 25th. So you put all that together, right? You put COVID, you put the fact that pipelines across the country are flush. I'm working with one bank. They've hired an LSM. So an LSM is a business that's licensed by the SBA to work with SBA lenders to help them process their packages. They've hired that company or third party because they're just stuffed to the gills. They don't have the processing power to get all of these loans through the pipeline. So as you can imagine, what used to take me, for instance, a week, takes me now 4 weeks. And every day I'm having these conversations with people. Now that's affecting everything. It's not only affecting the bank process, it's also affecting the appraisals. It's also affecting phase ones and phase twos if necessary. So it's affecting all different types of parts of the process.
I'll try not to take much of your time then, because I'm sure you've got some harried borrowers right now if they got this backlog and you've got a deadline to get the loans funded. Wow. So, okay, to prepare people for what to expect, what sort of information are they typically going to have to pull together to get an SBA loan approved? Nobody likes to go through the due diligence process, but we do. And we explain it to the owners, you're going to have to give up this type of information anyway. There's some information from the businesses and some information from the borrower. Big picture checklist, what would you prepare people to assemble?
So the first thing I would say is carve out time. That's the obvious one, but it's also the most important one because the people I'm working with, right, they're typically doing something during the day. If they're a business owner buying another business, they have to attend to that business. I'm working on several partner buyouts right now, which the SBA 7A loan is perfect for that. And so the first thing they need to carve out is time. Now you said, what do they need? So my checklist from the individual, my checklist includes 3 years of tax returns, their personal credit statement. And what I do there is I ask them to go and pull their free credit statement and send that to me. And I need their score and I need all of the trades that they have outstanding. So credit cards, automobile payments, other personal loans, etc. So I'm definitely going to need that. Then I go a step further. And this is because I've been in banking. Many brokers don't ask for this, but I do. I also ask for them to provide me with all statements that support their liquidity position. So checking, savings, money market, if they have, for instance, stocks, etc. I ask for those statements, and here's why. Bankers are always glass is half empty. It's always half empty. And by the way, chief credit officers think everyone's trying to steal and cheat and lie to them. So when I get a personal financial statement, which is another thing I need, where people list their personal assets, their personal liabilities, their income, they list specifically any real estate that they own, etc. When a chief credit officer gets that personal financial statement, unless it has supporting documentation to confirm what's on it, they typically don't believe it. And you know what? A lot of times people do embellish, maybe they have, let's say, 150,000 in the bank. Maybe that's 250 in their mind, because they're going to inherit some money 3 years down the road. So who knows why, but a lot of times people do embellish. So we need tax returns, we need personal financial statement. I do ask for backup bank statements, et cetera, to confirm the liquidity they state. And again, the personal credit report is something that I also ask for. So that's just the individual. Now, the seller also needs to provide documents. The seller, they need to provide 3 years tax returns for the business. They need to provide P&L statements for the last 3 years, and balance sheet that correspond. If we're working with a business that has accounts receivable, then we need accounts receivable statements, accounts payable statements. And in COVID, and I'll be very specific here, this is what I'm asking for in COVID to get deals done. Because when you look at about from April until now, people's P&Ls look a lot different, right, than they did before COVID. Some of them look extremely enhanced, which I've worked with businesses. I've worked with an individual that etches on glass, and his primary customer is the wine industry, exploding. But I also work with businesses, for instance, a reprographics company in Carlsbad, and they saw a steep decline. So what I'm asking for specifically in COVID is monthly P&L and balance sheet for April, May, June, July, August. And then what I'm asking for are those same statements for the previous year. Because what I want to see is, how has this year been materially different than last year? Now, here's what we need to see in order to get the deal done. We need to see what I call an inverted bell curve. So in April, right, most businesses went down, but we need to see that as we progress through COVID, that customers are coming back, revenues are starting to ramp up. And if I'm at approximately, I'd say around 75% of normal revenue and profitability levels this year with projections, I'm typically successful in moving that into underwriting. And what I mean by that is I like to say no to people before we get to underwriting. And again, I work with my business development officers to structure the deal so that once we're in underwriting, this isn't, hey, I hope we get approved. No, it's, well, we've structured the deal. We've put together the fundamentals, and we've uncovered all of the potential hurdles, and we've put it together in such a way that when it does get to underwriting, it's going to get approved. And here's the only unless, and this just happened to me a week ago, unless something materially changes. And that's something in a deal that I just had, which was a business acquisition. The female had everything else. I mean, she had direct customer or direct experience. She owned the same business essentially that she was buying. And what happened was is she failed to make a payment on an outstanding liability. And when we pulled credit again, it showed as delinquent, and it literally plummeted her score approximately 100 points, took her below the 640. And that was, again, that's something that is not going to happen very often. It happened in this case. She's such a good borrower. I said, look, take care of that. Come back to me once you're around 700, 720, and we'll help you buy another business.
Okay. Well, Ryan, you and I kind of take it as a given that if someone's going to acquire a business, they're going to look to an SBA loan, a 7A loan. But put it in perspective. You worked at a bank. You've seen borrowers or people who want to acquire a business come in for financing. In terms of the total loans you've seen extended to people to acquire businesses, what proportion of them are SBA loans and what is financing that's not SBA lending?
This is what I would say. I would say that everything that is small business, right? So anything where the business is, let's say, it's hard to say, but let's just use 30 million as an example. Let's say any business that's 30 million or less in revenue, annual revenue, and it's truly a small business, and the purchase is, let's say, somewhere south of 5 million. The overall price is south of 5 million. I would say that, and this is me speaking from doing these types of deals inside of a bank. So this is real. What I'm telling you is as good as you're going to get. Maybe 1% of people would qualify for a non-SBA loan to acquire a business for a company that's, let's say, 30 million or under in revenue and 5 million or less in purchase price of the business. And here's why. The reason why is that conventionally, number one, amortization is maxed out at 7 years instead of with the SBA, which is, and I can tell you experience that chief credit officers these days, they were doing this in the 80s. Some of them doing it in the 70s. And what I've come to find out is that in the 70s and 80s, the chief credit officers back then were pounding it into their young proteges not to allow more than a 5-year amortization on business acquisition. So even though in most commercial bank policy guidelines, it's 7 years for amortization, the chief credit officers these days, they're going to have a hard stop at 5 years. So the first obstacle to acquiring a business conventionally, not using an SBA 7A guaranteed loan, is that your amortization goes from 10 years to 5 years, which obviously increases the annual debt service. decreasing cash flow and now making it much more difficult to qualify for what we call the debt service coverage ratio. That's the first thing that is a huge obstacle to overcome. And then here's the second thing. Conventionally, lenders still want to have collateral. So what they're going to do is they have ratios a bit different, but typically the ratios look like this. They want to have a liquidity ratio. So essentially a conventional loan to buy a business, which I've done, means that the business owner buying the business doesn't need the loan. They can go to the ATM machine, and that's true. They don't really need the loan. But I worked with people who never have to work again in their life. Their children never have to work again in their life. Their children's children, grandchildren, nobody ever has to work in their lineage ever again. But they come to the bank for a loan because they believe that the business should support the loan and pay it off. Those are the type of people who can qualify conventionally because of the minimum liquidity thresholds. That just means cash in the bank. Minimum real estate holding thresholds, and then also minimum tangible net worth thresholds. So those are the three buckets: your liquidity, your real estate holdings or your lendable equity, and then your overall tangible net worth. For people who live within a out of the ocean and drive around, in the most up-to-date, elegant vehicles, and who go on exotic vacations and who don't need bank financing, they can buy a business using conventional financing. They're really the only ones. Everybody else, they're going to need an SBA 7A guaranteed loan. And for reasons I've stated, 10-year amortizations, 10 to 15% cash injection, only 5% post-close liquidity requirement, and then collateral. For business acquisitions, I have lenders that'll literally go up to what they call $2 million in blue sky. So I'm working on a business acquisition right now. It's actually a partner buyout. The individual there owns 15% of the business. He's not going to have to inject any additional capital because his ownership is going to act as the cash injection. In addition to that, he makes a nice income, but he has no cash. He likes to live high on the hog. And in addition to that, he doesn't own a home. So he has no collateral. And the loan's going to be about $2 million. It's going to be $2 million uncollateralized with a very minimal backup liquidity position. That would never fly conventionally. It wouldn't even get in the door. But we're going to get that done because this gentleman who is going to buy this business from the current sellers and his partners, he's the general manager. So the day that he owns the business 100% instead of 15%, nobody at the business knows it. The current 85% owners, they don't ever come to the business. They're passive owners. They started the business, they operated it, and then they left. So that is the type of loan that can easily be done, again, without collateral.
What are the typical terms of an SBA 7A loan? The standard terms.
Yeah. And I like that because they are standard. Conventional all over the board because a particular bank is setting that. But at the SBA standard operating procedure manual sets the rates. And typically what I see on loans over $350,000 is that the rates are based on the 10-year treasury plus 2.75%. So right now, I'm sorry, not the 10-year treasury, prime. So for instance, right now, prime's at 3.25%. Most loans are going to be over 2.75% over prime. So right now, most business acquisition, unless they're very strong, are going to be priced at prime, anywhere between prime plus 2.25% and prime plus 2.75%, 2.75% being the max. And people have to understand that the loan is variable. So are there fixed rate SBA 7A business acquisition loans out there? There are. There are very few banks that will do that. And let me tell you, it's almost like trying to get a conventional loan. You have to be very strong, which means there has to be a lot of post-close liquidity, 100% collateralized with real estate. So just a little tidbit, the SBA does require partner banks to require real estate collateral whenever there's a shortfall. So that's not the bank saying, oh, we want more collateral. That's the bank saying, we need more collateral, because if we put this loan on and the SBA comes back and says, hey, they had real estate collateral available and you did not assign it, well, guess what? We're not going to honor our guarantee. Now you have to deal with this loan on your own, and you're going to take the hit. People don't understand that. They always say to me, hey, Ryan, well, this is SBA guaranteed. They have no risk. I said, no, wait a minute. The SBA has auditors. Those auditors go into banks. If that loan is not documented properly, and if the banks did not follow proper procedure, the SBA will say, no, thank you on the guarantee. We're not going to enforce that. You don't get the guarantee. You're on your own.
Let me ask a couple of questions here, Ryan. We've talked about individuals being able to qualify for 7A loans. How often do you work with business to business acquisitions? Say there's a couple of owners of a business and that business is going to acquire another business. Is that a loan that you can do under an SBA 7A loan?
Yes, but it always comes back to the individual. But what you described there is individuals who would acquire the business, but then they would have what's called an affiliate under SBA guidelines. Affiliates are any business that you have more than 50% ownership in. And so if you have over 50% ownership, you typically have controlling ownership. And so those businesses are considered affiliate businesses. Here's the good thing about affiliate businesses. The good thing is that affiliate businesses are able to be used for their cash flow. So let's say, David, you own a very successful manufacturing company and you want to buy one of your competitors and you have controlling interest. Let's say you're 100% owner there. So the SBA will give you credit, quote unquote, for the cash generated to you from that business. Here's the downside. That business will have to guarantee the loan as well. So let's say you're going to start up a new company. So I'm going to go to David King, the lawyer, and I'm going to, have you help me create a corporation. We'll create a new corporation. We buy the business. So the new corporation is the borrower. And a lot of people get this mixed up. They think that them as individuals are borrowers. So the new entity would be the borrower, but then any individual who's going to have more than 20% ownership in that new entity and acquire that business, they're going to be guarantors. And then any income stream that will be included in cash flow, whether it's an affiliate, maybe it's, some passive real estate investment, that entity will have to be included as a guarantor on the loan. So that's how that would work. If, for instance, a couple partners or even one individual who operate one business are buying a competitor, they would still acquire it as individuals who start a new entity, who guarantee the loan, but that new entity would be the actual borrower itself.
I see. So is that the only way you can do it, that the individuals have to acquire the new business and, even if they're going to operate them kind of in conjunction with an existing business that they have, the existing business can't be the 7A borrower and acquire the new business as new assets that are taken into the existing business? It has to be the individuals that borrow under 7A?
So the individual, so you could do that. So for instance, again, the individuals are the guarantors.
Mm-hmm.
And you either create a new entity, which most people do because it's a clean balance sheet.
Sure.
And they would incorporate then the assets of the acquired business into that new entity. But they could, if, for instance, they're buying a business that is, let's say, the same business, they could just roll those assets into their existing business. That existing business could be the borrower. And again, those individuals would then be the guarantors. Okay. Most of the time I see people create a new entity just because it's a lot cleaner and it's a start line for the acquisition. Okay.
So since you're a pitcher, let me throw you a curveball here and just throw in another one. Could we structure a deal as a stock acquisition? I mean, say the seller wants capital gains on their stocks and they organized as a C corporation maybe, but for some reason or another, they've got to sell the business as a stock sale. Could the buyer qualify for a 7A loan if they're going to buy the stock of the business and then still turn around and pledge the assets of the business as collateral for the loan? Is that a feasible way to do it?
So a stock sale is
Hmm.
allowed and permitted
Okay.
per SBA Standard Operating Procedure Manual. Here's usually the rub. The rub typically is if it's a stock sale, all of the debt of the business comes with the business. Whereas in an asset sale, all the debt is wiped out. So typically, if a business is being acquired, because we're adding a loan that was not there before, we're adding a lot of debt to the business. Adding debt on top of existing debt makes the debt service coverage fall below acceptable levels. Does that make sense?
Absolutely. Yeah.
But
Yeah.
can it be done? It certainly can. The obstacle is most businesses are carrying debt. Like the landscape company I'm doing right now, they're wiping out 6 vehicles that have debt on them as an asset sale. And we spoke about the stock sale option because it's a key employee who's buying the business. And at the end of the day, what that key employee did was they went to the seller and said, and this does happen, right? When you have a business that you own for quite a while, you like to have toys, especially maybe in landscaping where those toys have engines, and us, grown up boys like things with engines and that rev. And so this seller had acquired a lot of equipment and tools that had debt on them for tax mitigating strategies, but they weren't required. And so the buyer said to the seller, I was on the phone, hey, seller, we don't really need these vehicles. You wanted them, but we don't really need them. So what I want you to do is I want you to actually keep these on your balance sheet, which they would because it's an asset sale, and then dispose of them your own way. But I don't even need those on my balance sheet going forward.
Let me ask you another type of question, Ryan. If you're working with someone and right from the very beginning, you can kind of tell they're not going to qualify for an SBA loan to acquire the business that they want. But for whatever reason, they absolutely want the business. It is the best thing for them to acquire that business and go on and have, the joy and prosperity of owning their own business.
Mm-hmm.
Then where would you guide them to look? I understand that there's state programs that are sort of akin to the SBA. I know that there's also the kind of the new the ROBS plans where you concentrate all your retirement risk in a business you're acquiring.
Mm-hmm.
What would you recommend that people do if they're not going to qualify for an SBA loan?
So what I do is, and I'm going to address the California Guarantee Program. I'm in California as you are, so that is definitely on the table. But the first thing that I do when I have a phone call with people is I tell them very simply, look, I don't take any money up front. There are other brokers out there. They'll say, hey, give me $2,500, give me $5,000. I've heard even $10,000. Give me some money up front and I'll work on your deal. And if we can't get a deal, oh, well, it costs you between $2,500 and $10,000. I don't do that. What I tell the buyer or the prospect in this case is, look, I align my goal with your goal. And what that does is that incentivizes me to tell you no on this phone call right now, saving you a lot of time, saving you a lot of money. So if I'm speaking with someone and let's say they go, Ryan, they say I have 500 credit score. I said, we don't have a loan. No one's going to give you a loan with that. Let's say they don't have any cash. They haven't. And I have those conversations all the time. Do you have liquidity? Do you have cash in the bank? No, I don't. But I want 100% loan. You're not ready, what I tell them. So if they don't qualify for an SBA 7A loan, they're not going to qualify for the California government, or I'm sorry, the California state guarantee either. And here's why. What's different about the California state guarantee is that the state guarantee program doesn't get involved in the actual loan itself, meaning the rate, term, the amortization, or anything like that. It's a lot different in that respect. The state guarantee program works with banks directly and says, look, we'll provide a guarantee based on your approval, but our guarantee is to you, but you get to set the rate, the term, amortization, maturity date, all of that, right? So now we're back to conventional lending, which was max amortizations of 5 or 7 years. So if someone's not qualifying at 10 years with a 10% cash injection, they're definitely not going to qualify at 7 or 5. And in addition to that, with the state guarantee, most lenders, again, they're With the state guarantee, because it is a bank underwritten loan and not the state guarantee underwriting the loan, they're going to default to most of the time 20-25% cash injection. So if someone doesn't qualify for an SBA 7A loan to purchase a business, here's what I tell them. These are the fundamentals. You have to have experience. You have to have cash in the bank. You have to have good credit score. You have to have a good business plan. You have to have all of these things to be able to acquire a business. So if you don't have them today, I'm incentivized to tell you that. I'm not incentivized to be glass half full. I'm not incentivized to tell you, yeah, I really think we can do this. Let's spend the next month to 2 months together trying to get this done. I'm incentivized to tell people, go back to your day job, get your house in order, prepare, get these fundamentals where we need them. And then when I have the ammunition that I need to go get an SBA 7A loan for you, then I'll go get it. About time, efficiency.
Absolutely, Ryan. And that is so true, that there's people who were meant to be business owners, but they just might not be there yet today. It's not right. Major League Baseball where we have to do it at a certain age or it sails away. There will be the right time to do it, and just wait, prepare. Time is your ally here. Mm-hmm. I certainly trust that when you're working with people, you absolutely have their best interests in mind, and you push them in the right direction to do what's in their best interest and help them get where they need to be.
That's right.
Do you have any other advice for people, say, looking to borrow other than, keep your credit up and that sort of thing? If they're going to borrow to acquire a business, say 4 or 5 years from now, what advice would you have for someone?
I would say stick to what you know. So for instance, I'm working with an individual who has 30 plus years in hospitality management. That goes miles with a bank. When I can look the bank in the eye and put a resume in front of them that says, look, this individual is buying a retreat right now. So I'm working on a retreat in Gualala, California, which is just north of San Francisco and Bodega Bay. And I can look that bank in the eye and say, we have good credit. We have direct experience, 30 plus years experience in the industry. That goes such a long way. So the first thing I would say is the business you want to buy, don't just close your eyes and cherry pick a business. Like, I want that business. Don't do that. Stick to what you know. And for instance, I've had people call me and say, I want to buy a car wash. And I said, well, do you have any experience operating a car wash? No, I don't. I said, okay, go work at a car wash. Go work at the car wash. Go get a second job, third job, whatever you need to. Go work at the car wash, make yourself a manager, and then come back to me. There's a real great success story here in San Diego. An individual who owns a local franchise. He bought his first car wash. He had no experience, but he was able to acquire a car wash for $75,000, 100% financed by the seller. It was basically in disarray, wasn't earning any money. He got the equipment for $75,000. He now owns the single largest franchised car wash business in San Diego. He's all over the place. So, but he was willing to start really small, learn how to do it before he went big. So that's what I would tell people. Stick with an industry that you know. If you're not in that industry today, get in that industry, become the expert. And then along the way, by the way, David, save some money, right? We're going to need to have a cash injection. So save a little bit of money. Oh, by the way, yeah, you had this credit card charge off 10 years ago. Call the credit card company and see if you can actually make that final payment. See if you can do that. That goes over huge with banks if that's going to show up on your credit report. So get your house in order, stick with an industry you know. If you don't know it, get in that industry, and then come back once the fundamentals are ready.
That's also great advice for young people today. There are loads of ways to be successful in your career. Not everybody has to go to medical school. Not everybody needs to build a bomb. Find something that you're going to enjoy doing, that you're going to be happy, that you can stay focused with, and apply yourself over your long career, and you can be hugely successful at something, at what you want to be doing. So that's key. That's great advice. Ryan, thank you so much for your time. I know you've definitely got to get back to all those loans that are pressed for time and need to get funded by the 23rd or the 27th.
The 25th is the Friday before the 27th. So yeah.
Well, maybe you'll get a little sleep before then. But so anyway, thanks again for your time. This was a great podcast. This is crucial that people who are going to sell their businesses or look to buy businesses understand that the SBA 7A program is essential for transactions and selling businesses. So thanks again for all your time. And with that, I'm David King, and this is Selling Your Business. We will see you next time.